Welcome back. Now, S&P Global expects the pause in Trump's tariffs to have a moderate impact on its growth assumptions. Once fully implemented, it may have a bigger impact. For now, the ratings agency expects global growth to come in at 2.7% this year and in 2026. This is just a 0.3 percentage point lower than the group's most recent forecast. Elijah Oliveros-Rosen, chief economist for emerging markets at S&P Global Ratings, joins us with greater perspective on this and what it may mean for emerging markets. Elijah, thanks so much for your time this afternoon. Now, I can imagine how difficult it's become to pinpoint and forecast global growth prospects in such uncertain times. Talk to me about how you've been navigating this environment and mapping out your outlook for the year and years to come under the Trump administration.
Thanks for having me. Yeah, I mean, if you think about last year was a year of clear resilience. Growth was very strong despite high interest rates, high inflation, and now we're going to a year of high uncertainty. So how are we thinking about this? There's obviously a lot of things that we don't know. We don't know what's going to happen after this 90-day pause on the higher sort of level of tariffs. We don't know the final result of a couple of Section 232 investigations on things like semiconductors, pharmaceuticals, copper. We don't know what the exemption on certain electronics, when that's going to end. But what we do know is that the epicenter of trade tensions is clearly focused between US and China. This is a conflict that has been going on for many years. It's a conflict that's likely going to stay beyond the second presidency of Donald Trump. So we know that the impact on the global economy starts from there. So economies that are tied to the US or to China are likely to feel the weakness in those economies. So that's a starting point of how we are thinking about our economic forecasts.
And talking about that starting point, we do know that there will be a hit on global growth. There has also been murmurs of recession talk and recession fears within the US. What are your expectations on that front and whether we will see a downturn in the US economy?
Right. Certainly a lot of noise around the US economy and how the tariffs will hit growth. Our view is we're not in the recession camp. So we see growth slowing from about 2.5% in the last quarter of last year to about 1.5% in the last quarter of this year. It's a significant slowdown. It's growth below potential. The main reason why we still don't see a recession is because if you look at the employment numbers in the US, they're still quite strong. And let me give you one data point, which is very important to sort of see whether we're heading into recession or not. And that is non-farm payroll employment. If you look at the 3-month average in the US, it's running around 200,000 jobs per month. The neutral or the natural rate of employment in the US, which by that I mean how many jobs are needed to sort of absorb the new people coming into the job market, is 100,000. So we're twice that. So still a pretty healthy job market despite what's going on. It certainly will soften. We certainly will see softer growth as well by consequence, but we're not yet at the recession camp, given what we're seeing on data.
And it's interesting to see those data points because when you look at the soft data, we are seeing consumer confidence, business confidence coming in lower as well. We also have heightened inflationary risk. With that being said, what are your expectations on a monetary policy front? Do you still expect to see one interest rate cut this year? Or can we expect more cuts or a more dovish stance from the Fed as we start seeing and understanding the scope and scale of those US tariffs?
Yeah, it's going to be a very challenging year for the Fed. Clearly, tariffs will impact inflation in the US. Inflation is likely to head towards 4% at some point this year, significantly above the 2% target of the Fed. And growth is likely to slow. However, the Fed has to be very careful on not stoking further inflation. So we are a bit conservative on how we view this playing out in the monetary policy side. We only expect one rate cut by the Fed this year, which is different than what the market is pricing. And the market is pricing in 3 rate cuts. So we're a bit more conservative. I think partly because how we see the economy. We don't see the economy going into recession. We see the economy soft, going to sort of a soft space, which I think is going to give the Fed some caution as well.
And let's take a deep dive into EMs at this moment, right? With that global picture playing out and your expectations for one rate cut from the Fed, how do you expect emerging markets like South Africa to sort of navigate this environment and, your growth prospects on that front?
Yeah. So the good news for EMs in terms of central banks and their policy is that the dollar is weakening. So we've seen some stability in many EM currencies, including the rand. The rand is slightly up this year, slightly up over the last 12 months, which diminishes some of the fears of this pass-through inflation from the currency to prices. And in an environment of weaker growth, I think a lot of EMs are actually going to shift to cut rates even more aggressively than the Fed does. We've seen already many EM central banks cut rates. The South African Reserve Bank has paused in the last meeting and sort of citing external risks. But inflation is close to 3%. Growth is slowing. Well, growth, at least the growth prospects are a bit you know worse off than they were a few months ago. So I think there's strong arguments for South African central bank to start cutting rates. They have to be cautious. But in terms of growth, we do see growth in South Africa picking up from last year. Our latest forecast is 1.6% for this year. However, that is before some of the tariffs that have been announced. We do think the pressure on South African growth is to the downside, not only because of what's happening with tariffs, but also what's happening with the national coalition, which is pushing some downside pressure on reforms as well.
It'll be interesting to see what Lesotho does next month. We also have that inflation print coming in tomorrow morning. Elijah, thanks so much for your time and just sharing your insights. That was Elijah Oliveros-Rosen, Chief Economist for Emerging Markets at S&P Global Ratings.